We are back. This is Macro Money. I'm Ilias Pivak, head of Global Macro here at tastylive. And we are going to focus today as the markets slow down for the end of the year and we wade through the inter-holiday period here between when most markets go offline for the Christmas holidays and the thing repeats once again next week, only across even more markets for the New Year holiday. We are left without really actionable news, left without the kind of big data-driven outcomes, at least this week, that we might expect. And so rather than try to look for things that may not necessarily be all that relevant and give them more importance and more attention than perhaps they're worth from a tradable perspective, we're going to instead focus on FX markets' performance over the past year, take a look at how it might have been allocated for at the start of last year and what it says about where things are going next, and try to land on what is a framework for trading currencies in 2024 that sets us up and at least gives us an overlay for what there is to expect, what to buy, what to sell, what should perform better, what should perform worse, at least within the confines of the framework that we're going to lay out here. So first and foremost, what we are going to do here is consider how 2023 looked for the major currencies and why that was the case. Extract from that what seemed to be the driving catalyst. Consider what that might look like as applied to what's going on in 2024, and then see what kind of outcomes that might produce if one were to just say, okay, here's my simplistic way of looking at how these markets work. Here's how I would allocate a portfolio. Here's what I would be a buyer of. Here's what I would be a seller of on this basis. So let's start with a bit of year in review. And here it is about as encouraging and about as textbook for currency markets as you might want it to be. What we see here is on the x-axis, the policy interest rate change for the major six economies that offer a tradable currency and that we offer as futures to the audience here. So we look at what the liquid options here have done. So we have here the six major liquid FX currencies that have futures attached to them with deep markets, that have options on those with deep markets, to kind of get a sense for the driving narrative. So what the change in policy rates looks like for these economies is on the x-axis. How the currency performed is on the y-axis. And so the vertical axis. And so what you see here is, generally speaking, the classic currency market dynamics hold, where interest rates went up more, the currency generally did better. You can see that by the upwards sloping dashed line here that we have approximating the relationship. So generally speaking, where interest rates were higher and rose more, the currency performed better. Now, there are some nuances here that bear looking at and that reflect, let's say, the influence of catalysts other than interest rates being a sort of overlay on this. So, for example, you can see right here that the British pound did a little bit better than did the euro. So this UK dot on the FX return spectrum is a bit higher than the dot for the Eurozone, though interest rates went up a little bit more in the Eurozone. You can see it's a little bit further along on this scale than is the UK. And much of this seems to be the result of political normalization last year, this past year, versus in 2022. Famously, in the preceding year, the British pound was particularly beaten down relative to the euro because of political instability. Everybody kind of made fun of the very short-lived premiership of Liz Truss. There was a lot of back and forth with outgoing Prime Minister Boris Johnson, who would replace him. Once things kind of settled this year with Rishi Sunak at the helm, we saw the UK find a bit of a political normalization, political stabilization tailwind on top of rates that allow the currency to outperform a bit, which we can see is the polar opposite of what happened for the very same reasons in 2022. Here's the preceding year's results. You can see the euro had fewer rate hikes than did the UK, but the UK underperformed for these very political reasons because all of this political turmoil was ongoing. So what we see here is essentially normalization relative to what we saw right here. So whereas the Eurozone had fewer hikes and performed better than the UK in FX terms in 2022, it was the reverse. The UK had fewer hikes and performed better than the Eurozone because that political risk unwound. Japan, as ever, the weakest amongst all the currencies, both in 2022 and this past year, because Japan didn't raise rates and everybody else did. So yield differentials moved against the yen across the board. There's a bit of a deviation here between the US and Canada. And again, you can see comparable performance, but for Canada, slightly stronger currency with slightly lower rate change than you got in the US. And again, it's nearly a perfect inversion of what happened in the preceding year and a kind of normalization. You can see essentially the same amount of rate hikes, 4.25 out of both of these economies, but the US vastly outperformed the Canadian dollar, and that's because stocks fell in response to this kind of aggressive policy tightening. And indeed, when rates went from essentially zero over the course of 2022 up by more than 4 times, when you look at what's going on in the US and Canada, that's likely to give a negative response from stocks because then financing economic activity of any stripe and thereby financing corporate earnings becomes 4 times plus more expensive in a very, very rapid fashion. So not surprisingly, stocks didn't like it. And when stocks don't like things and they come down and the market has diminished appetite for risk, you tend to see a cashing out. Hence, stock markets were down for the year across all the major US indices and across the world for the most part as well. Now, when you have that kind of liquidation, that kind of cashing out, the cash of choice into which to go naturally ends up being the US dollar a lot of the time because it is the most liquid. It is by far, as a matter of fact, the unit of commercial exchange and therefore the most liquid currency that exists at this point. According to the Bank of International Settlements, the US dollar accounts for well over 80% of global monetary transactions. So it is vastly more different, or vastly more liquid, rather, vastly different from virtually any other currency because of this. And so you end up against that backdrop with the US outperforming because of this additional benefit, not just higher rates, but also the risk aversion that comes with that. As you get to this year, the mood in markets is much better. In fact, we're looking at the NASDAQ, for example, on pace to finish the year at new record highs. The S&P flirting with its record highs. Even the beaten down Russell attempting to make a break higher out of its long-running range. So there is a much better risk appetite backstory to 2023 than the singularly negative view of 2022. And so the US dollar doesn't get as much of a premium, as much of a tailwind from risk aversion. As a matter of fact, it gets a little bit of a knockback because some of that extra cash sitting in dollars as a haven comes back out and enters riskier parts of the market in hopes for a greater return. And so you see Canada, a more cyclical, a more risk-sensitive sort of currency, performing better, the Canadian dollar, performing better than its U.S. counterpart, though there is a little bit less there in terms of rate hikes. Now, Australia, another slight deviation, a little bit more rate hikes there than in the US or Canada, but downbeat performance because the same way that Canada is anchored to US performance, because most all exports out of Canada go to the US, and so it is very much dependent on US demand. So when you got a slightly stronger US economy than people expected in 2023, and that gave you that risk on tilt to sentiment that we're talking about here. Where that didn't show up is in a resurgent China, which has been anemic all year despite reopening from COVID restrictions in December of 2022. And of course, for Australia, that's the main export market, bar none. So you saw a little bit more of an anemic performance here. Nevertheless, generally, if you consider how this stacks up, you might have done quite well, even with these deviations, just looking at what the forecasts called for rates-wise and ranking them. So if you looked at this performance in 2022 and you said, right, more rate hikes means a stronger currency. That's what this chart is telling me. So if I looked at what the forecast for rates is going to look like in 2023, I would say rates are expected to go higher the most in the Eurozone and the UK. So here's where effective interest rates were by the end of 2022. Here's where the markets had them baked in 1 year out for 2023 year end. Here was the change. There was going to be the greatest rate hikes in the Eurozone, followed by the UK. And the weakest performance was going to be in Japan and Canada. Japan was going to see a slight rate hike. Canada was going to see cuts. So if you took a very simplistic approach and said, okay, we're going to rank these 1 to 6, knowing nothing else, we're going to buy the top 2, sell the bottom 2. How would that work out? Well, now that the year is almost at an end, let's consider. In the case of the UK, the pound was actually the best performing currency last year. it rose 10.4%. That made it the best performing against expectations of second best. So it's outperformed by one ranking point. But of course, the big standout was Canada. And here, it's that better US economy that really did the trick, it would seem. Because whereas expectations were for cutting, perhaps because all of those aggressive US rate hikes were going to crush demand, as it turned out, the US economy was stronger than expected. And so Canada ended up not only not cutting, it ended up raising rates by another 75 basis points. And so Canada vastly outperformed by 4 ranking levels. It should have been the weakest. It ended up being second strongest because of this difference. Now, if we took our hypothetical portfolio of buying euros and pounds, selling yen and Canadian dollars, and we did the set it and forget it method at the beginning of 2023, we just put that on and walked away in equal size in US dollar terms. So exactly the same things in exactly the same size. What did we learn? Well, being long the pound would have paid off to the tune of 10.4%. Being short Canada would have cost a loss of 7.3%. Being long the euro underperformed, as we can see here. It ended up being third best rather than first best. So it missed its ranking by 2 spots, but still gained 6.6%. And then being short the yen actually outperformed. The yen was supposed to be, as we can see again here, seeing a bit of a rate hike. And instead, nothing, no rate change. So the yen actually underperformed and fell 8%, over 8%. So it missed its spot by 1 ranking level. And when you add all of this up and you say, well, I was short this, so that's a money-making proposition in this hypothetical, again, performance, hypothetical portfolio. That's a gain, that's a gain, that's a gain, and that's a loss. Again, holding constant the currency and the position size in that currency's terms, in this case, the US dollar, this portfolio would have yielded 17.8% returns for the year. So there is deviations, sure, without question. But looking at this solely on the basis of simplified, where are rates going to be a year from now, kind of logic, and saying, all right, I'm just going to blindly buy the top 2, sell the bottom 2, let's see what happens, monetary policy would have won the day. Now, let's consider what this looks like, of course, going forward. Because now we are going to be looking at this dynamic in reverse. These are global PMI numbers. As ever, they are centered around 50, which is neutral. And what they're telling us here is the state of the US economy as a kind of bellwether for the world. It is, of course, the world's largest economy. And we can see that much as the world at large, it's come to a standstill. So what we're looking at here is, as ever, numbers above 50 connoting growth, below 50 contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see here that the US economy has essentially ground to a halt. So with a composite reading most recently here at 51, we are looking at an economy that's growing, but so slowly that it's within a hair of standstill, with services doing the heavy lifting and manufacturing in contraction mode, and indeed accelerating to contract faster over recent months. And this is a story that's mirrored to degrees greater and lesser across the major economies. So China, for example, likewise near standstill. The Eurozone already almost certainly in recession. The situation in the UK, very recession adjacent. Developing markets, for the most part, excluding China, still growing, but at a much slower rate than they did, let's say, around mid-year of 2023. So this is generally a story that's mirrored across almost all major economies to various extent. And so it isn't surprising then that when we look at where the one-year forecast is for next year, we find that standstill and a slight increase in rates in Japan, that's the outperformer. When in fact, elsewhere, we're looking at substantial rate cuts. And on this basis, if we again did the same exact thing and said, we're going to buy the top two, sell the bottom two. In the case of the US, we're looking at anywhere between 1.25% to 1.5% in cuts. And it's the same thing for the Eurozone, which would imply that the dollar and the euro are going to underperform. In Australia, there's cuts, but they're seen as the most modest of these six major economies where cuts are occurring. In the case of Japan, of course, they're not occurring at all. We're looking at, again, the tepid possibility that rates come off the zero mark and inch up just a hair into positive territory. So Japan is seen outperforming. Whereas the situation elsewhere is cuts. In Australia, it's only about 0.5%, which is much less than the UK or Canada or the US or the Eurozone, where it's a question of something between 1.25% and 1.5%. So the kind of blind model portfolio approach here would say, let's have a portfolio of buying yen and buying the Aussie and selling the US dollar, selling the euro. Now, one caveat in all of this is that historically, it seems to be that about 2 years on average after the start of a Fed rate hike cycle, there is some kind of a spike in volatility. So the Fed has told us that it takes about 12 to 18 months for a single rate hike to be fully absorbed into the economy. And of course, they've been on a hiking campaign. So absorbing rate hikes is a growth negative, sentiment negative kind of a thing, one would think. So that kind of comports with what's going on here, which is to say, the Fed estimates up to 18 months for a single rate hike to get absorbed. And here, 24 months, which is a very similar sort of story here, is the separation between the start of the hiking cycle and that hiking cycle essentially breaking something and the markets finding some kind of a crisis. the timing is very adjacent, especially since the 2-year lag, the 24-month lag is, of course, an estimate. Sometimes it's a little bit faster, sometimes it's a little bit slower. So it may well be that we're on the cusp of just such a spike right about now. So if that's the case, then we might expect the US dollar to perform better than this implies, because again, it would benefit from this kind of risk aversion as it did in 2022. You'd again see a round of profit taking and a round of liquidation that should benefit the dollar. So it might be a standout surprise in this entire landscape. The yen, of course, is already that kind of currency. So on rates grounds and on policy grounds, the yen seems to have a strong bid for being the best performing currency next year. The dollar might be the kind of outsized surprise that Canada was in 2023. But as we can see here, outside of Canada, everything else generally held pretty close to what you would expect. And so if the same kind of thing is what's ahead, then looking at this might well mean the US dollar is the surprise risk. So perhaps throwing it off the table and saying, these are the things to buy, and Canada and the Eurozone are the things to sell, may well be how a portfolio could be adjusted. But as ever, surprises do occur, and nothing is absolute, and nothing is to say that this necessarily has to be the way that markets work. As a matter of fact, buying the Australian dollar in this kind of a scenario might be exceedingly painful, because it, like the Canadian dollar, of course, is also a commodity-linked currency and is also very linked to market turmoil. So the same logic that might have you opt not to be a seller of US dollars might make you not a buyer of the Australian dollar. But what does seem to come out of this kind of thinking is, first and foremost, the yen looks particularly weak and now has scope to become particularly strong as those things that kept it weak the past 2 years go into reverse. And the performance elsewhere shapes up to be a reflection of where rate cuts are greatest versus where they are least. And that, of course, will be subject to the various path forward that these central banks choose. But at least as an overlay and a baseline for analyzing those nuances, considering the past year was a masterclass in those nuances mattering less and the interest rate story mattering most, as we can see here, what this analysis then allows is for a helpful baseline against which to forecast and against which to allocate exposure. And that is macro money for today. Hopefully that was a helpful way to think about FX markets as the calendar gets ready to turn to 2024. As ever, macro money is here right after overtime this week, Tuesday through Thursday, because of the holiday. It'll be the same way next week, and then we'll return to our usual Monday through Thursday schedule right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, talking about what happened on Wall Street on a given day and what that might mean going forward. I'm also writing for the News and Insights section of tastylive.com and opining sporadically on Twitter or at least the platform formerly known as Twitter, at @IliasPVAC. Thanks very much for joining. Good luck out there. See you tomorrow.